Tonight, two people open their first investment account. Same age, same salary, same $400 left after rent. Marcus spends 6 months researching stocks, watching crash predictions, waiting for the perfect moment. Derek buys the most boring fund, sets up an automatic transfer, and forgets the app exists. 30 years later, Derek retires with over $1 million. Marcus ends up with less than half. Same money, same market, same 30 years, not because Marcus picked bad investments, but because he barely participated. My name is Joe. By the end of this video, you'll know exactly what to do with your money in 2026, in what order, and why. The honest truth about 2026. The S&P 500 returned 25% in 2024, 18% in 2025, and is up 11% so far in 2026. Here's the problem. American stocks are at the second most expensive valuation in 140 years. The Shiller-Cape ratio sits at 40.7, the long-term average is 17. The only time it's been higher was December 1999, right before the dot-com crash wiped out nearly half the market. 7 companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, now make up 35% of the entire S&P 500. Vanguard projects U.S. stocks returning just 5.5% annually over the next decade, not the historical 10%. When you buy expensive, future returns shrink. That's arithmetic, not pessimism. Why waiting destroys you? Your thinking sounds like I should wait. That instinct is completely human and completely devastating financially. In 2012, analysts claimed the market was overvalued by 50%. People waited. The crash never came. The market is now 4 times higher. Those people missed 13 years of gains while being technically right. Here's the stat that settles this permanently over every single 20-year period in American market history, including the Great Depression, dot-com crash 2008, and COVID. The S&P 500 has never lost money in real inflation-adjusted terms. Not once in 140 years. An expensive market doesn't mean you wait. It means you execute a boring, low-cost plan. Your money is dying right now. Inflation hit 3.8% in early 2026. The average savings account pays 0.38%. $10,000 sitting untouched for 10 years still reads $10,000 but only buys $7,400 worth of stuff. You lost $2,600 with no crash, no scam. You just stood still. Standing still is the bad decision. The market has historically returned 10% annually, roughly 7% after inflation. $1,000 at 10% becomes $17,400 in 30 years. You did nothing. The money did everything. Charlie Munger said the first $100,000 is the hardest. $500 monthly at 7% takes 11 years to get there. The next $100,000 takes 6. The one after that, 4. Every wealthy retiree simply survived long enough for the money to take over. The real enemy is you. In 2024, the S&P 500 returned 25%. The average investor earned 16.5%, an 8.5-point gap not from fees or fraud, but from behavior. Buying high, selling low, waiting for clarity, repeating endlessly. JP Morgan found that missing just the 10 best days in a 20-year stretch collapses your return from 10.6% to 6.4%. Miss 30 days and you're at 1.5% worse than a savings account. A buy and hold investor turned $10,000 into $64,800 from 2003 to 2022. Missing those 10 days left you with $29,700. Here's the brutal part. 7 of the 10 best market days happened within 15 days of the 10 worst. The moment you panic sell is statistically when you're about to miss the rebound your entire return depends on. We're building a portfolio the TAM panicked version of you can't easily destroy. Before investing a single dollar. Kill high-interest debt. Average credit cards charge 21-24%. Paying off a 22% card is a guaranteed tax-free 22% return, better than Warren Buffett's career average. Above 7% interest, destroy it first. Below 5%, invest alongside it. Between 5-7%, do whichever helps you sleep. Build an emergency fund. 3 to 6 months of expenses in a high-yield savings account paying 3.5-4.5% in 2026. This is armor for your portfolio. Crashes love arriving the same season as layoffs and medical bills. Without this, you'll be forced to sell at the exact bottom. The emergency fund lets you look at a crashing market and feel nothing. The bucket system. A 401k isn't an investment, it's a container with tax rules. Same investment, different bucket, completely different outcome. 401k up to employer match. Most employers match 50 cents per dollar up to 6% of salary, an instant guaranteed 50% return before the market does anything. Yet 1 in 4 workers misses their full match. Americans leave $24 billion unclaimed every year. Log in this week and fix it. HSA. High deductible health plan? This is the most tax advantaged account in America. Contribute up to $4,300 individually or $8,550 for families in 2026. Money goes in untaxed, grows untaxed, comes out untaxed. Triple tax advantaged. Invest the balance in index funds and let it compound for decades. Roth IRA. Open this yourself online. Contribute up to $7,000 annually under $150,000 income. Pay tax now. Every penny, including all growth, comes out completely tax-free in retirement. Contributions can be withdrawn anytime without penalty. The complete order, 401k up to employer match, destroy debt, above 7% finish emergency fund, max the HSA, max the Roth IRA, keep filling the 401k taxable brokerage for everything beyond what to actually buy, not individual stocks. Professor Hendrik Bessembinder analyzed every U.S. stock since 1926. 4 out of 7 return less than Treasury bills. Just 86 companies produced half of all market wealth ever created. The top 4% account for everything. Professional managers aren't the answer either. In 2024, 79% underperformed the S&P 500. Over 15 years, more than 90% lose to the index. The answer is the index fund. You buy the entire haystack. You can never miss the winning 4% because you always own them. Real tickers. VTI 0.03%, FXAIX 0.015%, FZROX 0.0%. The average actively managed fund charges 1%. That difference on $100,000 at 7% over 30 years costs you $187,000. A quarter of your wealth gone to a fee you never read. Want zero thinking? One target date index fund with your retirement year in the name. Holds everything, rebalances automatically, costs about 0.08% at Vanguard or Schwab. Simple 2026 portfolio, 60% U.S. total market, 30% international VXU, 10% bonds BND. Vanguard projects international returning 4.9, 6.9% annually versus 3.5, 5.5% for U.S. stocks. When 7 companies make up 35% of your index, international isn't optional. It's the seatbelt. Meet Sarah, the whole system in action. Sarah is 27, earns $62,000, has a 401k matching 100% of her first 4%, $3,800 on a credit card at 24%, and until today, her strategy was don't look. Month 1 sets her 401k to 4% employer, immediately matches dollar for dollar. That's $2,480 of free money per year she was donating back to her company. Every spare dollar, about $450 monthly, goes at the credit card. Month 9, card is dead. Killing 24% debt was the highest returning investment on earth. Guaranteed months 9 through 18, that $450 builds her emergency fund to $7,000, 4 months of expenses, earning 4.4% while keeping her from panic selling during a crash. Month 18, Roth IRA opened at Fidelity in 11 minutes. Automatic $450 monthly into a target date 2065 index fund. App closed. At 7% return, her 401k plus Roth delivers approximately $1.1 million by age 65 without a single raise. Total management time, 20 minutes per year. 3 decisions and a direct deposit form. 4 traps coming for your money. The 1% advisor. Consumes roughly a quarter of your final wealth, typically to put you in index funds you could buy yourself. Need real help? Hire a fee-only fiduciary charging hourly. Never pay a permanent percentage of your net worth. Whole life insurance as investment. Someone will appear after your first decent salary with a policy that's both life insurance and investment. It's a worse version of both, which is exactly why they found you, not the other way around. Crypto. Bitcoin hit roughly $109,000 in January 2025 and has shown extreme volatility since. After your foundation is complete, cap speculation at 15% of your portfolio. Treat it as exactly that speculation, not investing. When the crash comes. At some point, you'll open your app and see your portfolio down 30%. Given 2026 valuations, possibly more. This isn't a risk, it's a scheduled event with an unknown date. Decide right now, while calm, when the crash comes, you change nothing. Automatic transfer keeps running. Don't watch people explaining why this time is different. They said that in 2008, 2020, and 2022. Every single time, recovery, new highs, and a long line of regretful sellers who missed it. Write this somewhere. When it crashes, I do nothing on purpose. Future you at 2 a.m. needs that note. It will be the highest paid sentence you ever write. The whole playbook. Match the employer contribution, kill high-interest debt, build the emergency fund, open the HSA, max the Roth IRA, buy index funds, automate everything, mostly ignore it. There were no safe years. Every year had a perfectly reasonable excuse to wait. The market has spent a century transferring wealth from people who waited for certainty to people who acted without it. You don't need to outsmart this market. You just need to outsit everybody who tries. This is education, not personalized financial advice. Share this with one person who's been meaning to start since 2019. See you in the next one.